Hi everyone, so I've got quite the company for you today. It's a kind of a health conscious company, it's also a bit of innovative, but it's also a company that can sell vegetables at the price of meat. So when you can sell vegetables at the price of meat, that person's brilliant, and this company is brilliant. So when you look at these numbers, you kind of feel like this is a company I want to invest in. Um, in the 3 month period, like 3 months compared to 2019 to 2018, that 3 month period jumped 250% in revenue growth, which is extraordinary. The 9 month period, 255% growth. So when you look at these numbers, you think this is a great company. What's stopping me from buying this company? Well, I do hold stock in this company, but the problem is the one thing that I fear, you fear, is, well, the market value. The problem is the market value of this company. I'm just looking this up right now. Maybe you should have had this before that, but all good, everyone. All good. It's an $8.3 billion company right now, and it's at 114 per share. So at this price, it's pretty expensive, right? 114 per share, 8.3 billion, and given plus these two figures, and we'll probably get the rough financial year revenue, which is about it's about 290 million. So 290 million revenue for this. It's very expensive, right? But if you're growing at this rate, then is it expensive? So we have to kind of work our way through the numbers, right? Because when I'm given this scenario, I don't know if I'm buying something of really good value. Because when I brought this company, it was in the 80s. I think it was about $86 that I paid. It's at 114 right now, and I'm sitting on a decent profit. I haven't sold yet, but I'm considering reducing my position or potentially selling it all. I think it's still got some room to go up. Like, this company's got a huge potential, but I'm not too sure it's worth $8 billion, which is quite the sum. But you also have to consider that if you buy at this price, you're also buying a company that is going for world domination in terms of, you know, vegetables at meat prices, right? If you can if these guys can sell their patties well, they're going to do really well because they've got so many contracts, say like Dunkin' Donuts, which is about to roll out theirs. They've got McDonald's trialing it. So imagine if McDonald's trials their product, because they've already done the first trial and they've expanded it from like 20 something stores to like 50 or something. But imagine these guys get the worldwide deal. If these guys get the worldwide deal, that means so much for them. And the problem and the next biggest competitor is Impossible Foods, right? So like Impossible isn't able to scale up, so they actually came out and said we can't take the McDonald's contract because we can't scale our product fast enough because they've already got a Burger King deal with the Impossible Whopper, which is doing extraordinary. So that's why McDonald's has gotten like they're kind of wanting to come in and try to challenge that. So when we consider this and we go, given that they're going to be challenging, like they're going to be getting the biggest deals, the biggest contracts, and their next best competitor can't even scale that well, given the demand. So, like me, it's not that they can't scale well, it's just like demand is explosive because everyone kind of wants to reduce their consumption of meat. So, when you're considering beyond meats and you're going, if I'm paying 200, if I'm paying about $8 billion for a $290 million revenue, type company, that's not really making a profit. In the last 3 months, it made 4 million profit. So that's kind of a good signal for the future coming in. It means because at the end of the day, right, they've got their research and development, they've got their kind of overhead costs. But after that, once they can start scaling and selling more of their product, majority of it's going to be profit because you're again taking vegetables and selling it at meat prices, or even more expensive than meat prices, way more expensive actually. Um, so when we do this figure and we go, if these guys, so we can't assume that they're going to grow at 250% for the next year. So we have to consider maybe that these guys will grow at maybe, if we say like 100%, like we can't guarantee that this is the way, but we can see maybe like if they're able to grow at 100% and they're able to go to 90 million, then they would have 580 million next year. Or if they had less, how would you feel? That's the problem. If a company has 580 million, the thing is, these guys, if they earn that much, they could have like 30 million in profit or something like that. But still, 8 billion, which is very expensive. But that's the problem as well. Like, given their growth, like, you got to consider there's a lot of competitors coming in. Tyson Foods is coming in. There's also a lot of small players. I've seen those small players, but I can't remember their names. They're probably not going to make the biggest dent in Beyond Meats. There's also an opportunity in Asia for Beyond Meats, so there's a lot of consideration. I think this one's quite it's a risky one. I've got a video that I've put up about risk allocation. So if you want to consider how you should manage this one, you possibly want to consider buying in thirds or smaller increments. Buy in small increments, and you can always get larger as you go. Because depending on the pricing, it might have a big tumble if things don't turn out well. The problem is at an 8 billion valuation, you're pricing a company for success, and when you value something for success, it's good when it does well, but what happens when it doesn't do well? So I want you to consider that you're paying 8 billion. If you're a trader, you're just going to be like, everything's in, the momentum is in their favor. Their stock could keep going higher than $114. I certainly think it can do that, but I'm not too sure if it's a long-term sustainable kind of share price at the current, stage of the company. It could be well worth this later on. Even if they were producing 580 million, it's a big question of, are they worth it? I think once they get to here, then maybe they might justify this price tag. But we're talking like a year later. Of course, if people are trying to rush in, people want to buy into the future. And buying into the future is always great, because if you're buying the future, then when the future does come, you stand to benefit in a great way. I think Beyond Meats will do really well financially. You as an investor, you've got to consider, will the share price go higher? And that's a problem. I don't know if it can go higher, but I would say if you're interested, you can always buy a little bit, or you can just wait for the price to come back down, given that there's a lot of profits on the table for a lot of people. The minute things don't go well, there's a lot of profit takers that are going to be taking profits, and things could fall, but at the current momentum, I think things will keep going up for a little bit longer until we have to consider whether this is too overvalued, there's too much hype, and things are going to fall. So when we consider this, it's a great company. Like, trust me, you can look at these numbers, and if this valuation was a lot less, half the valuation, I'd be quite happy to buy into it. Which is why when it was at about 5.5 billion, that's what the valuation I was buying it at. I thought that was fair value, but at this value, I kind of see it being quite high, and it's pricing too much success right now. Of course, no one can complain when the share price is rising. So that's the thing. I want to talk about the companies that you're interested in, that I'm interested in. If I buy a company, I do my research. it's vital that you always do your research. You buy a company, you do considerable research. You know ins and outs. You know their partners. You know what their products are like. And I have had their product before, and it's not too bad. Like you're not gonna feel like it's meat, but it's close enough. It's close enough to leave you satisfied. Um, because like if you were to have a burger and it didn't have a patty that felt like meat, you'd kind of feel like that burger wasn't really a wholesome, burger. You just feel like it was just, two buns with veggies in it that someone just took a patty out of. So when you've got these guys, it does make a difference because just having the patty in there that looks like meat, tastes a bit like meat, it kind of just leaves you feeling a bit, you're definitely satisfied by the product. You know it's not full out meat, but you can accept it. And that's what these guys are doing really well. They're able to do a product good enough that people want to buy it, and they're signing up many deals with many companies. So that's the thing. I'd say keep an eye on the price. If the share price drops, maybe you can consider it an opportunity, given how fast they're growing. I would say 8 billion is pricey, but if you have FOMO, fear of missing out, then maybe you can buy a little bit. But let me know what you think about this company. This is my thoughts. I think it's a high growth company. I think the product's great. Just don't like the market valuation. But things always change. The thing is, when you invest in companies, you have to find companies that you like. Then when they come on for sale, you have an opportunity. The problem is if you don't know what companies you like, you won't know when there's a sale because you don't keep an eye on it. So that's the thing. Keep an eye on the great companies and buy it when it's at a good valuation. Right now, not so good. But you let me know what you think is a good valuation. Like everything is subjective. That's why we have the stock market. Like people who do well tend to, they're able to predict what's going to happen in the future. So they buy at a certain price, sell at a better price, and they do well. So like if you can do well, I can't question your method. I can only go with my method, and it works for me. So that's the thing. I think I hold the stock. It's a bit pricey, but I think it's a good company. That's why I'm talking about it today. That I like to just review these companies, talk about it, and it also just gives me a refresher of how I feel about the company. And to be honest, yeah, I'm quite might well just sell these shares if I. But I'm gonna do what a lot of people are doing right now and just wait and see because there's a lot of momentum in the stock. It just went up 19% yesterday. It should be quite interesting what happens today and the rest of the week, considering there's a trade deal on the way. So markets are very buoyant. And the problem, and well, it's not a problem. Like if you own the stock and there's a rationality coming in, well, let momentum take its place and let people feel like they're missing out and push the stock price higher. Just make sure you get out just in time to take your profits. All right, until next time, good luck.